Joseph, thank you so much for coming. And it's a very critical day, today and tomorrow, for the markets, for the equity markets. The futures has been rising on Greece deal optimism. But how realistic is this optimism? Because Bloomberg reported that 60% of the investors will take part in this debt swap. And it's going to be released tonight, and then most probably we'll know by tomorrow. But what kind of an effect can we have? Is this optimism, the futures rising, really realistic?
Well, I think there's two things to keep in mind here. First is that it's just as much of a relief rally as optimism. And the relief is that the Greeks looks like they're going to get the 2/3 votes necessary from private sector investors in order to have what we call an orderly default. This means the Greeks are not going to walk away from all of their debt responsibilities, leave the euro, leave the EU. So that's why we're seeing futures point towards a much higher open in the global equity markets, in the U.S. equity markets this morning, supporting the improvement that we've seen in Europe already in the early trading day. Okay, the second thing is that what we're going to see is an exercise of the Greeks' collective action clause, meaning there is going to be a default. Now, it should be very clear to global investors, large banks, and hedge funds that the Greeks are going to default. It's been quite clear for some time. So the market, at least for now, seems relieved that at least we're going to put this behind us. We're going to see a $3.2 billion default approximately. This will trigger credit default swaps. Now, previously, this was something that everybody in Greece wanted to avoid, but now they've decided, well, that's better than just letting the Greeks leave entirely.
Is it better?
It's better for international banks. I don't know that it's necessarily better for the Greek government or the Greek people, but it seems for now that they've made that decision.
How about ECB? Today we're not only seeing the Greek debt swap, but also ECB. Mario Draghi just announced that the inflation rate will remain likely about 2% towards 2012.
Well, you know, one of the interesting things is the European Central Bank, the Bank of England, the Bank of Canada all met today.
Right.
The U.S. Federal Reserve meets next week, and they're all having the same conversation, which is what are we going to do about risks to the overall economic outlook from rising inflation that has directly to do with rising prices of crude. The ECB basically said today that they're going to miss their inflation target in 2012. Now, given the fact that Europe's entered a recession, they've got, like the United States, they've got an enormous amount of labor slack and overall economic slack. My sense is that central bankers aren't too worried about inflation right now. The ECB does have a price target, and Mr. Draghi is going to have to go to lengths to explain to the broader global investor public what that price target is. What most central bankers are loath to say is these price targets are very flexible. They're what's called intertemporal, meaning that, well, if inflation's higher, a little bit higher than 2% this year, the recession that we're in probably means inflation will be a little bit lower than the target next year, and it should pretty much all even out. Nevertheless, they have to maintain their credibility. Mr. Draghi's going to have to address markets, and they're going to have to face up to the fact that rising oil prices mean higher fuel costs, means higher inflation.
And he's talking right now. And how about tomorrow's data in the U.S.? Let's come to U.S. We have seen ADP go up, right, to 216 to 15 was the estimates, or vice versa. And today we saw unemployment claims rising, but it doesn't mean much, I guess, because ADP is more important. But tomorrow's data is interesting. Everyone is talking about a 215. Increase, even though the prior number was 240, and we're talking about non-farm payroll. The 8.3% unemployment is going to remain the same. What should we expect from tomorrow's data? It's a very important labor data.
There's two things we should expect. One is we're going to see a nice another month of growth in in non-farm payrolls report, probably around 200,000 for the private sector. Once you net out what's expected to be another month of job losses in the public sector, it wouldn't surprise me if it's anywhere between 180 and 200,000. Now, what that means is over the longer term, that's what we call a slow grind down. The labor market's improving, but it's just not improving fast enough. If you take a look at where the problem is long-term unemployment. Right now, we've got, for many individuals, the length that they're unemployed is close to 40 weeks. That's an extraordinarily long time. And if you look at the underemployment rate, that's at 15.2%. So while things are improving, what we do have is we have sort of a structural problem here in the U.S. labor market. And what this tells me is in order to get back to what we consider to be full employment, say around 6 to 6.5%, we're talking several years.
You wrote, talk about several years, a very important article in which you say fiscal drag likely to restrain overall growth in 2012 and 2013.
Right.
What are you talking about in this article in terms of the U.S. economy? What should we be aware of here?
Well, like many countries, the U.S. is running a large budget deficit, and indeed that deficit is not sustainable over the long term. So what we're seeing is government spending being curtailed. And the way it's done right now is we're going to take some pretty big hits in defense spending and means-tested entitlement spending, and that's going to create what's called a net fiscal drag. In other words, we're going to have roughly about a 1% drag on growth this year. Now, the policy risk here is next year, where the Obama tax holiday, the Bush tax cuts, both disappear. In addition to the Obama healthcare tax increases also taking place. When you add these things up, they could create a 2.9% hit on overall it's equivalent to 2.9% of overall U.S. GDP. So in an election year, that means there's substantial risks that are building in the economy that won't be taken care of until the very end of the year in late November, early December. Now that may harm growth in a very specific way. Investors and firms may delay spending and investment decisions while they await, one, the outcome of the U.S. presidential election, and then two, the lame duck session of Congress after the election, where they have to make these very big decisions on what to do about the expiration of those tax cuts.
So towards the 2012 end, what do these all mean? Tomorrow we have the short term, and let's look at long term and short term. We have the Greek debt swap. We have the ECB who is going to talk about interest rates, inflation, and then we have tomorrow's data. And then we have also the Obama, stimulus, which is ending, the 2009 ARRA that you mentioned, which is going to cause the fiscal drag, right? So Brinier, who's one of the Salomon Smith Barney's portfolio managers, ex-portfolio managers, who is now the Brinier Associates president, he says that S&P 500 could reach 1,700 and above 1,700 by the end of this year. What do these all mean in terms of the equity markets? Where should we see it?
Okay, well, Laszlo Barini is a very bright guy, and he's making a claim that the S&P could rise to 1,700 based on economic fundamentals. Now, I would have to agree to disagree with Laszlo. We may see a rise in the S&P 500, but that will have more to do with global central bank liquidity and refinancing operations. Laszlo is so bright that my sense is he's betting on the Fed jumping back in and purchasing more assets this year, and that being a net stimulus.
Is that going to happen? Sorry for interrupting you, but yesterday at Wall Street Journal and the online version, we saw an article about Fed's potential QE3 which was going to do some controversial buyback program, mortgage and treasury. Is that really possible?
I think that it's likely that the Federal Reserve will opt on the side of caution and give the economy an extra boost via another round of asset purchases. Whether those are sterilized or not is open to question. The point here is that every time global central banks move in and begin to buy assets, equity prices tend to move higher. Now, 1,700 is a very optimistic call. Right now, global equity markets seem to be on a sugar high that has little to do with any connection to fundamental economic data and everything to do with policy distortions caused by extreme accommodation on the part of the Fed, the European Central Bank, the Bank of Japan, and the Bank of England.
So like Brinier said, you think that Fed will come into the market, and that's why he's basing his assumption on S&P 500 being about 1,700? Yeah,
that's a very optimistic view, but basically he's playing on the global central banks trying to create the mother of all wealth effects.
And also, a couple of days ago, we had a correction. You also, gave me some comments which I shared with our audience. And again, talking about other investors, they say that investors should stay in the market, not leave during these kind of corrections. Was this a correction, or was this a change in the upward trend?
That was a foreshadowing of what I think is a likely correction of, say, 2 to 5%. Look, as an economist,
foreshadowing of 2%
to 5% correction in global equity markets.
In the global equity markets.
Simply because there's no fundamental connection to economic growth in these markets. The U.S. is growing at a rate around 2% right now. That's well below its long-term growth trend of 2.5%. You would tend to see equity markets begin to move upward if the economy is going to begin growing above trend. But the signs are that that's just not the case. Right now in the first quarter, the U.S. economic growth is tracking at around 1.4 to 1.5%. It's early. We're going to get some better data that'll probably send it up to say 1.92%. But it's really hard to make the case that these equity markets are moving based on a 2% rate of growth here in the United States at a time when Japan's economic growth is contracting, at a time when Europe is in recession, and when a time when the UK is hardly growing at all.
Yes. Our time is up right now, Joe. But we want you to come back again.
I'd be happy to.